and welcome. Just as most of the world was slowly bringing the pandemic under control and the global economy was recovering from the shocks of COVID-19, global financial conditions have further tightened due to various macroeconomic factors. In this episode of Endeavour Explains, let's dive into the details of the why and the financial crisis facing the world today. Most economists were expecting 2022 to be a period of strong economic rebound. Expecting businesses would return to full operation post-COVID, consumers would be free to spend their accumulated savings on all the leisurely activities they had not been able to do during the pandemic. People expected it to be the start of the decade of consumerism, just like the one that followed the 1918-21 influenza. Fast forward a few months and the more commonly cited parallel is the 1970s, when the Arab oil prohibition helped create a prolonged period of economic hardship. Inflation surged to double-digit rates even as economies around the world stagnated, a painful mix of high prices and low growth known as stagflation. Now, stagflation is again on the cards. After the double shock of COVID-19 and the Russian invasion of Ukraine, inflation rates have exceeded expectations, surging to the highest levels in decades in many countries, while economic growth forecasts are rapidly deteriorating. The prospect of stagflation's return strikes into policymakers because there are very few monetary tools to address it. Raising interest rates may help reduce inflation, but increased borrowing costs would further depress growth. The war in Ukraine is one of the major factors for global economy tightening and is particularly pronounced in Eastern Europe and Middle Eastern countries with close ties to Russia, reflecting lower equity valuations and higher funding costs. Financial stability risks have risen on several fronts, even though so far no global systemic event affecting financial institutions or markets has materialized. A sudden reprising of risk resulting from intensification of the war and associated escalation of sanctions may expose and interact some of the vulnerabilities built up during the pandemic, leading to a sharp decline in asset prices. With the sharp rise in commodity prices anticipated to add to pre-existing inflation pressure, central banks are faced with a challenging trade-off between fighting record-high inflation and safeguarding the post-pandemic recovery at a time of heightened uncertainty about prospects of the global economy. Incoming inflation data suggests more decisive tightening of monetary policy is necessary in many countries. After rising early in the year on concerns about the inflation outlook, advanced economy nominal bond yields have increased further since the invasion amid heightened volatility of rates. Inflation break-evens, a market-implied proxy for future inflation, have risen significantly on the back of sharply higher commodity prices. Repercussions of the Russian invasion of Ukraine and ensuing sanctions continue to reverberate globally and will test the resilience of the financial system through various potential amplification channels, including direct and indirect exposures of banks, non-banks, market disruptions in commodity markets, and increased counterparty risk, poor market liquidity and funding strains, acceleration of cryptization in emerging markets, and possible cyber-related events. The war has already had an impact on financial intermediaries, non-financial firms, and markets directly or indirectly exposed to Russia and Ukraine. Let's dive into some country-specific details. Europe bears a higher risk than other regions due to its proximity, reliance on Russia for energy needs, and the non-negligible exposure of some banks and other financial institutions to Russian financial assets and markets. Banks' direct exposures to Russia are relatively small except for some non-systemic European banks. Banks' indirect exposures are more difficult to identify and assess because they are less well known, especially the extent of interconnectedness, as it is difficult to quantify them in absence of detailed and consistent disclosures by country or specific activity type. The latest regional economic outlook lowers the growth forecast for Europe. For advanced economies, the growth projections are cut by 1 percentage point to 3% in 2022 from January projections, and for emerging economies, excluding Ukraine and Russia, the projected growth is cut by 1.5 percentage points to 2.7%. Several major economies such as France, Germany, Italy, and the United Kingdom are projected to barely expand or even contract for 2 straight quarters this year. activity in Russia is forecast to shrink by 8.5% and in Ukraine by 35%. Germany is among the hardest hit with its energy-intensive large manufacturing sector and export-oriented economy. Over the past 6 months, economists have halved their 2022 economic growth forecast for Germany while inflation expectations are 3 times higher. The war is a serious setback to Europe's strong yet incomplete recovery from the pandemic, which left the private consumption and investment well below pre-coronavirus forecasts, even as fiscal and monetary support underpinned an impressive rebound in employment almost to the levels last seen before the pandemic. Spiking energy and food prices are now cutting deeply into household consumption, and economic uncertainty is poised to restrain investment. In the US, the Federal Reserve faces the delicate task of cooling inflation, which is at the 4-decade high, without raising rates so sharply that it brings on a recession. Historically, the central bank has struggled to pull off such a soft landing. Most economists argue that it has only done so once in 1994 when the then chair, Alan Greenspan, oversaw a doubling of the benchmark rate without killing economic growth. Another warning sign in the recent weeks has been an inverting of the curve, plotting yields on short and long-term US Treasury bonds, an indication that investors are becoming pessimistic about the economy's near-term prospect. An inverted yield curve, which occurs when investors turn away from stocks towards less risky bonds, has preceded all 8 US recessions since 1955. Although the timeframes between an inversion and a downturn have varied between months and years. Since the war in Ukraine began, emerging market hard currency yields have increased at a rapid pace, akin to earlier episodes of emerging market stress, before retracing some in mid-March. The number of issuers trading at distressed levels has surged to nearly 25% of the issuers, surpassing pandemic peak levels. The deterioration in spreads, combined with increase in US yields, has pushed financing costs well above the pre-pandemic levels for many borrowers. Markets remain open for issuance at those higher levels for funding costs. Flows in local currency bonds and equities have come under pressure, experiencing the largest weekly redemptions since March 2020. Tighter external financial conditions on the back of US monetary policy normalization and heightened geopolitical uncertainty are likely to increase the downside risk for portfolio flow. The Federal Reserve's bid to calm inflation by raising interest rates and withdrawing emergency stimulus programs is gearing up just as the global economy is displaying worrisome signs of weakness, aggravated by the war in Ukraine and COVID's continuing hold in industrial supply chains. The risk, some economists said, is that the Fed and the other central banks that are implementing similar anti-inflation policies may adjust too slowly to a complex and fast-changing global landscape. Slower growth and rising prices, coupled with the challenges of war, infection, and tightening financial conditions, will exacerbate the difficult policy trade-off between supporting recovery and containing inflation and debt. Russia's invasion of Ukraine will pose the biggest challenge for economic growth, with the region's advanced economies hurt most by reduced demand from Europe and emerging markets feeling the effects of higher global commodity prices. The latest World Economic Outlook lowered the 2022 global growth estimate by 0.8 percentage point to 3.6%. It reflects a 1.1 percentage point cut for the euro area, now seen expanding 2.8%. Because Asia's advanced economies have strong ties with Europe, the continent's weaker growth will weigh on external demand and ultimately growth for major regional trade partners like Japan and Korea. Most of Asia's emerging and developing economies are net importers of oil, gas, and metals, making them particularly vulnerable to rising global commodity prices. That means that a deterioration in their terms of trade, a measure of prices for a country's exports relative to its imports, will likely reduce growth, weaken currencies, and worsen current account balances. High food and fuel costs also add to inflation pressures, especially in lower middle-income countries where they make up a large share of consumer spending. Coronavirus infections in most of Asia have retreated from their peaks during the rapid spread of the Omicron variant, with mobility indicators approaching pre-pandemic levels. China is the most notable exception to this, as lockdowns in Shanghai and elsewhere idle a wide range of activity and threaten to cause further disruptions to the regional and global supply chains. These lockdowns are one of the major issues that will affect Asia's emerging economies through reduced trade and demand. Further, the tightening of US monetary policy that is materially faster or larger than currently expected by the markets, or both, would have large spillovers to Asia. If disruptive capital outflows occur as a result, central banks in affected countries could respond through the judicious use of all their policy levers in an integrated fashion. The downside risk of capital outflows is mitigated in countries that have built up strong buffers but is amplified where high debt conspires with vulnerabilities. Finally, a greater slowdown in China's economy due to broader virus lockdowns or other risk factors such as the continued weakness in the real estate sector would also have large implications for the region. Given trade linkages within Asia, more broadly, a potential fragmentation of supply chains and added geopolitical tensions will remain risks for longer term for a region that has flourished in recent decades from rising wealth and other economic gains from globalization. The war in Ukraine has brought to fore a number of medium-term structural issues policymakers will need to confront in coming years, including the possibility that the geopolitics of energy security may put climate transition at risk, the risk of fragmentation of capital markets, and possible implications for the role of US dollar, the risk of fragmentation in payment systems, and the creation of blocks of central bank digital currencies. More widespread use of the crypto assets in emerging markets, and more complex and bespoke asset allocations in an effort to preempt the possible imposition of sanctions. The war has made evident the urgency to cut dependency on carbon-intensive energy and to accelerate the transition to renewables. We hope the policymakers will take a note of all of this and more, and hope that the world may see a much reduced impact of this ongoing financial crisis.